Hey guys, what's up? Thanks for tuning in. We're doing a bunch of things at the same time. So we're doing this live webinar on Zoom. So maybe you join through our platform, or we're doing it through YouTube as well. So yo everyone, thanks for tuning in. So we have a lot of time today for questions and to help you guys navigate this whole fundraising stuff. So let's get to it. I see some lag here, so let me try this instead. Okay, cool guys. Um, so the first thing I'll clarify, and not so much for the Zoom guys, for you guys on YouTube. I am not Slidebean. My name is Caya, if in case you didn't know that. Hi. And I'm the CEO at Slidebean. So a lot of people seem to think that the YouTube channel is just named after some nickname that I have, but no, it's actually a company. It's a big team. And what we do beyond making YouTube videos is we help founders navigate fundraising. We've been doing this for 12 years or so. So the YouTube channel has kind of pivoted a little bit into a bunch of different content, and we talk about a lot of stuff beyond startup funding now. But this is still what we do. And the whole reason why we do this is because raising money really, really sucks. We are a venture-backed company. We raise money ourselves. I went through that. I've gone through that process thrice. First company that I started, we failed to raise money, and we ran out of business, and it sucks. So I try to take some lessons for the second time around. So yeah, what I want to do today in this session, it's going to be about 30 minutes at least in the stuff that I have beyond the questions that you have. I'm following you guys on the chat, and I'm following you guys on the webinar chat on Zoom and the live chat on YouTube. So we'll have a bunch of time for questions. So about 30 minutes of slides is what I have. But yeah, so the whole idea is that, funding, we spend so much time funding or fundraising that we end up kind of thinking that funding is the end game, right? Like raising money seems to be like the solution to our problems. And for many founders, for many of us, it is, right? Uh, if we're bootstrapping the company, if we didn't raise money before, if we are using our own cash, if we don't have a salary and we're living off on ramen noodles, the packaged ones, not the good ones. Um, funding does seem like the end game, like the end goal, and it's a 6-month process at least. So like I see so many founders kind of stuck in the whole funding game when in reality funding, and we have to remember that funding is really just a means to an end. Now the means to an end is, I think, something that a lot of founders also get wrong sometimes, because the end game for a company is not necessarily uh, profit, as you might think. The end game for a startup company that raises venture capital, really the end game is either selling the company or IPO. So, well, what about profit, right? Isn't the purpose of building a business to make a profitable business? Well, yeah, kind of. We made a video maybe a couple years ago on why startups feel a little bit like Ponzi schemes. And it's I can see why people can make that connection, but that's not really the case. But let me walk you through one scenario to kind of explain how that would work. So here's a scenario of funding. Let's say we want to raise a $1 million round, right? I'm sure that many of you, if you're watching, you're thinking of raising money. You've seen these rounds of funding happen. Like I'll never forget that when I was starting my first company, this company that existed back in, it was 2012, I think, raised $1 million. And it was just this app where you could just yo people. You can chat or anything. You could just send yos. It was really weird, but they raised $1 million. So it's like, oh, if yo can raise $1 million, anyone could raise $1 million. But let's think about the logic behind a $1 million round for a startup and see where there may be a glitch in that whole profit premise. So if you're thinking of raising $1 million, if you're thinking of raising money, you've probably heard, or you've probably seen a reference of, hey, like I don't want to shed more than 15% of equity in a round of funding, right? Founders need to retain at least 85%. And that's not completely crazy, but it's going to be crazy in this scenario. You'll see in a sec. So let's say that we found an investor, they put in $1 million and they're getting 15% of the company, right? So 15% in exchange for this capital. Now, what what happens later? Let's imagine that this company does decently well, and a few years later, let's say, I don't know, 5 years later, they manage to get to $10 million in annual revenue. Great, sounds like a good, exciting opportunity. Fantastic. Okay, so what, so how much of that is profit? Well, typically for a company, your EBITDA margin, your profit margin after all your expenses could be something like 10%. That's not crazy and out of the ordinary after you pay for marketing costs and all that. So 10%. Okay. You have to pay taxes on that, corporate taxes. So if you're in the States, that's going to be about 20%. So you're going to end up with around $800,000 in net profit, right? That's the clean money that the company got out of after all expenses, after everything. Great. So let's share this wealth with the investors and with people that invest in the company, founders included. Okay. So what do? Well, you pay investors their proportional share, 15%, right? And that translates to about $120,000 out of this $10 million company. Great. Okay. So you guys see the problem with this? $120,000 in payback, at least 5 years later. That's 1 year of revenue. So you need what? You need like 9 years at least to just pay the investors back on this capital that they raised. And that's if the company does well, right? The company doesn't die halfway, product doesn't work, no competitor comes in and beats them, right? So like that's not a very exciting opportunity. Like as an investor, do I want to risk $1 million to maybe 10 years later just just get it back, and then who knows when I'll get more? I'll get an ROI, a multiplier of what I invested, or interest or whatever, like profits for the investor. No, like this doesn't work, right? So that's why these companies can exist that that only get to $10 million in revenue and that are not looking to sell, but they can't raise money the way startups raise money. And that's the big difference. Why? Because the whole premise of the way a startup raises money, sorry, is completely different. So let's see the scenario for an actual startup. So scenario two. So scenario two, again, we'll establish that there's a $1 million funding round that we need to raise. But as startups do, we'll probably need more rounds of funding, right? So, these 15% that investors got, well, maybe there will be a new round of investors that comes in, and this new set of investors, has to dilute themselves. They have to give some shares to the new investors too. So they end up with maybe 12%, maybe down to 10%. I don't know. But they get a smaller slice of the pie after a new round of funding. This, of course, happens many times, but I'm simplifying here. Okay, so what happens next? Okay, maybe let's say that this company reaches $50 million in annual revenue, but makes no profits. There's no, it maybe loses money every year still, right? But it's making $50 million in revenue. That means a huge customer base, etc. So what could happen with this company that's still losing money every year? Again, it's not going to share dividends with investors. Well, what they're going to do is, well, maybe a bigger company is willing to buy them out. And if that happens, then that would be kind of exciting, because in startups, and this is not a Ponzi scheme, that's where the Ponzi scheme disappears, this whole premise. Well, what if a company is willing to pay 5 times revenue for this business? And that happens, and it happens a lot in startups, right? For SaaS companies, for subscription businesses, a good multiplier even these days is 5 to 6 times subscriptions or annualized subscriptions, not too different from annual revenue. Or, we've seen ranges of all the way up to 12 times ARR for a multiplier, for a valuation for a company. And if a bigger company believes that this technology or this team can help grow their product, they are willing to pay for that. And that's the whole point of startups. So if that happens, investors are going to get 12%, not 15%, but 12% of that $250 million. That's a $30 million payout for the investors. So a 30 times ROI, 30x ROI within the span of a few years. So in 7 years, like that is the game that venture capital plays. And it's a very risky game, by all means. It's super risky. Why? Because you're essentially operating a company at a loss. So you're risking losing money every month. You need further rounds of funding to continue operating, because otherwise, you could run out of money anytime. So it's a very, very risky game. But if it happens, and if you do it well, you can achieve this super fast growth. The idea, I mean, you're not striving profits. You're reinvesting everything, and maybe even raising more money to reinvest more into just growing and very quick domination. More investors are going to be needed. That means that not only the first investors, but the founders themselves are going to be diluted, right? The company's going to issue new shares to these new investors, and your percentage is going to shrink over each round of funding. I was reading this report the other day that by the time companies get to Series A, on average, as a standard, the whole group of all founders will only retain about 35% of equity. So after you raised pre-seed, seed, and Series A rounds, which we'll get to in a sec, Founders are normally left with all founders all together with around 36% of the company, and that's normal. That's pretty much the standard. Again, they're looking to, they're aiming for a smaller equity share or equity percentage in a really, really huge business. So a lot of investment rounds are going to be needed, and the only path in which these companies make money, or the investors make money, make a payback, is if they exit or sell. There's no game of, hey, like, we're going to hold to this company, I'm going to inherit it to my children. That's not the game of venture capital. It's always an exit or an IPO. To Anne asking if I can read the chats, I can read the chats. It's live. I'm not cheating, man. Like, it's an actual live stream. All right, cool. So let's talk a bit about the funding rounds themselves. So we established that funding really is just a means to an end, right? So one to the other. But like I said, we have a bunch of funding rounds that we need to do to get to this end, especially if we need to scale so quickly. If we want to make a unicorn, a billion-dollar company within the span of 5, 7, 10 years, we're going to need to pour a lot of money into it, and we need investors to give us that money. And so there's been some nomenclature established about the naming of these rounds. If you look, and this runs out of date all the time. You'll see that, if you read documents that are 2010 and before, what is established as a pre-seed or a seed round is completely different from what we understand a seed round is today. So one reason for, I don't want to say misinformation, but confusion, right? It's confusing because this has changed a lot. Even in the whole dot-com bubble conundrum in the 2000s was because private venture capital didn't exist in the way it exists now. So companies had to raise money from the public markets. Story for another day. Maybe you watch that video. Okay, but let's talk about these rounds and what they mean. So biggest mistake founders make when approaching this stuff is that they'll think, or they assume that a seed round is one that you raise right after you launch your product. So maybe you bootstrap, you use some of your savings, you kept your day job, you've been grinding at this product for 6 months, you go and you launch it. You release it, right? You put it live in the ether of the internet, and now you go and look for investors so that you can grow this thing. That's the shittiest and the worst time to raise money. It's a really, really bad position to be in to raise money, because investors have a lot of leverage against this company. Why? Well, because you're essentially a product that's live. And the whole idea of investors is that there's FOMO, right? You have to create this FOMO with investors. It's like, hey, if you don't invest now, you're going to miss out on this huge business. And you might invest later, but it's going to be at a much higher valuation. So you're going to get fewer shares, etc. So the opportunity is now, and you don't want to miss it. That's kind of like the message that we're trying to portray when you're pitching to investors. But when you've just put a product in the market and the product has no customers and no traction, then it's really hard to send that message, because investors, on the other hand, they have all this leverage where they can just say, no, well, let's just wait to see how fast does it grow. Keep me posted for a few months. But if you don't have money to grow it, it's not going to grow. If you don't have a sales team or a marketing team, it's not going to grow. So raising money just after you launch is a shitty position to raise money. Most seed rounds actually happen when you have something in the range of 20K in monthly revenue. For SaaS, this is, I don't want to say a rule, but this is as close as it gets. $20,000 to $30,000 in monthly subscriptions, not annualized, not annual run rate, but monthly recurring revenue. I think that's a great position to raise a seed round. Ideally, you've been growing that number of subscriptions, maybe 10, 20% every month. You understand a little bit of how to get customers. Obviously, these customers are in love with your product. Your product is done. You were able to build it. You launched it. There's a team, right? So that's the set of characteristics that makes up for a seed stage company. And you have a good chance of raising money if you meet those ticks. That also means that you must have launched way earlier, right? So launch actually happens between pre-seed and seed. As another example, for a Series A company, most companies raise a Series A round when they're in the $2 million range of annual run rate. Not just the revenue requirement, but obviously good unit economics, good metrics, churn. Your churn is low, you understand your customers, the team is working, you understand KPIs, a bunch of other requirements, but at least from a milestone perspective, $2 million in annual run rate. Now, notice that I've titled this slide like standard tech company, because this is what a standard tech company would work, or at least the way they would raise money. There's another type of tech company, which I like to call the R&D tech company. Companies in this group, I would say, are For example, biotech companies, I'd say that if your company's building like literally a new large language model like OpenAI, or like not building on top of OpenAI, but like building your own AI model for whatever, then you could probably classify as an R&D tech company. Hardware companies that are building actual things, like they don't operate in the other standard model that I was talking about. Why? Because you'll probably need multiple rounds of funding, manufacturing, lots of money before you can get to where you need to go. The launch may happen Series B or later, right? So those some software companies even require a lot of funding when they're building some new technology from scratch. But that's the minority of companies. Usually, there's usually a PhD in this cap table. There's usually some scientist person, at least in their space. But most of us are building standard tech companies. It's a software thing. We're building on top of some APIs, and traction is expected. So again, the biggest, if you still want slide, it's this one. If you want to, we're gonna have a recording. I saw that question. I mean, this is gonna be live it's gonna stay on YouTube. But if there's one slide that you want to remember, it's this one, because every round is always a bridge to another round, right? You have to, when you raise money, it should be enough to get you to the next round. And if you get stuck in the middle, that's again a really, really shitty position to be in to try and raise money. But let's actually break this down, at least for a standard tech company, what those rounds would look like and what those milestones might be. Okay, so pre-seed rounds, those exist. I haven't talked about those, but pre-seed rounds didn't used to, but now exist. So what's a pre-seed company? Let's establish that first. Again, a pre-seed company is a company that has a fully formed team. So all the founders that are ready, Y Combinator officially says that on an ideal pre-seed team, you want to have half of the founders be technical, at least. You have these. I run into these companies sometimes that are 3 MBAs that got together and try to build a company, and they don't have any technical founders, and they're building an app. It's like, dude, who's building this? An employee? No, it has to be someone with founder level experience, etc. Kind of like the Facebook story, Winklevoss story all over again. So a fully formed team, founders that have all the core skills to build this product. Again, Y Combinator would say half of them technical, and a clear picture of how you're going to get to your first 100 customers or first 1,000 customers. Why? Because whatever you have now with this money, it needs to last to seed. And you feel that raising $500,000 or whatever money you raise for pre-seed is going to be enough to recruit some top tier talent. It's not. Real good talent, say in marketing or in product building, is not going to come work for a company that's raised $500,000. Why? Because that means that the company has a runway of a few months. If it works, if things don't work, they'll be out of a job, and if they have a good job and is well paid. Why would they risk this? Risking this is not a question of money. It's a question of, hey, I believe in this product so much that I am willing to risk this. But money is not a solution to recruit people. So that needs to be, I'd say that those are hard requirements to raise a pre-seed round. And again, you're raising a pre-seed round so you can get to a seed round. So what's a seed round? Well, a seed round is, we established about 20K in revenue monthly. There's a product in the market. You're still growing, right? It's not that the company has stalled. 10% maybe, that'd be a deal. And of course, a good understanding of your growth metrics, because you're going to need to continue replicating those. Again, if you raise a seed round, you're not raising money to build a product. In pre-seed, yes, you are. You've maybe started the product, you have some mock-ups, but you're raising money to launch this product and get to seed. Now, some big red flags that we run into all the time with the companies that we work with is a company that's raising money to find their last co-founder. Big red flag. Why? Because if you haven't found your co-founder, you don't recruit a co-founder with money. You recruit them with the vision of the company, and that means that you have to go and pitch it to them, pitch the idea. You need a network to do that, and if you don't have a network, that's also a red flag to investors. So yeah. Another red flag for pre-seed is that the company has no idea how they're going to get customers. Again, the round needs to be enough to get to seed. You need to budget enough money to get your first set of customers so you can get to seed, right? So if you haven't budgeted for that, or if you're raising a pre-seed that only lasts until you launch, then investors can smell that, and it's usually a deal breaker. Yeah. Okay. So let's go to the next round. Again, for a standard tech company. So raising a seed round to get to Series A. How does that bridge work? Again, $1 million in annual run rate, which feels like a big milestone, is in the middle of this, right? Series A comes a little bit later. And the reason I'll say this is because, I'm speaking from experience. One of the reasons, I guess one of the reasons why we have a YouTube channel, but also why we are not at we're not a Series B company is because Slidebean, our company, we got stuck here in the middle. Literally, we launched our software product. Subscriptions were doing well. We raised a seed round, about $1 million, doing well. Like everybody back then, this was back in 2017. Everybody back then, investors, accelerators, every advisor or our blog article I read is like, hey, you should raise money for 18 months, which I did. So I raised money for 18 months of runway. I budgeted our expenses so that they would last for 18 months. 12 months in, I'm like, okay, we're 6 months away from running out of money. Let's go and raise our Series A. So I started going and pitching a bunch of investors. Hey, reaching out to a bunch of investors. Hey, we raised a seed. We're a Series A company. We're trying to raise money now as a Series A. Blah blah blah. Back then we had about $1.2 million in annual run rate in subscriptions. It's like, okay, like let's raise a Series A, and every single one of these investors would reply to me and say, oh, well, that's cool. I like what you're doing, but we're really investing in Series A companies that have at least 1.5, probably around $2 million in annual run rate. So no worries. We like what you're doing. Just come back when you get to 2 million annual run rate. I'm like, dude, I don't have money to get there. We're not profitable. We're burning through cash. How do I get to 2 million if I don't have the money for it? And that's hopefully a mistake that you can learn from, because again, if you get stuck between rounds, you're between a rock and a hard place, and it's really, really hard to raise money there in the middle. I'm speaking from my own traumas. So really important, make sure that when whatever money you raise for seed, it's enough to get to your Series A. Series A is, again, $2 million in run rate, especially for SaaS. Good traits of product market fit. So good retention, good stickiness. Customers are happy. They're using the product. Maybe they're upselling or buying more expensive plans. A fantastic understanding of metrics, because now you're going to go and raise a Series A that might be a $5-8 million check, and this check is not so much for product building. Now it's a matter of scaling, right? It's a lot of that money is going to go to marketing, growth, sales, whatever your channel is, and you need to understand really well that, hey, I'm going to pour $500,000 in this campaign or the next quarter. It's a lot of money. You have to make sure that the numbers work out. So that's what you need investors to understand when you're pitching them for Series A. Red flags that would not allow you to raise a seed round. You launched a product, but there's no revenue. You're not a seed company yet. You're kind of stuck in the middle between pre-seed and seed. Like I said, you're raising money for 18 months, but not necessarily enough money to get to Series A. You see this predicament a lot with founders. Like an investor will say, hey, like you're raising $2 million for your seed round. What if you only raise $1 million? Can you make it work? And a founder will like almost instinctively say, yeah, we can make it work. Like, well, no. If you only raise half of what you intended, you will get stuck in the middle. So what happens then? So that number needs to be a really educated number of how much money you need to raise. This kind of goes on, but I'll do the last one from Series A to Series B. Maybe some Series A companies in the audience, maybe. We've helped a couple companies in Series B raise money. We don't. By the way, small parenthesis, like anybody who says that they will help you fundraise is probably some form of really shady thing. Like all we do at Slidebean is like we help companies like prepare their pitch decks, prepare their stuff. But the pitching, the investor meetings, conversations and connections, that's the CEO's job, and it's nobody else's job. And anybody who sells that service, I usually think it's kind of fishy. But anyway, so Series A to Series B. So Series B is probably a $5 million ARR. By the time you raise your Series B, you should have a senior executive team that you've recruited from other places. Again, this means that this is people that you pay very well with your Series A money, that you probably snatched out of another company, and they have they're good, well experienced people as either CMO or chief of sales or VP of whatever. And by Series B, you probably want to have some early traits of how this company might exit. Right. So what are you going to do for an exit? Like who are potential buyers? You may not see an exit at least through Series C or D. You may be on a path for an IPO, but you need to have the answer to this question at this point. So yeah, red flags that would not allow you to raise a Series A, not enough revenue. You run out of money before you reach the milestone. Been there. Or just not understanding your metrics. That's probably one of the biggest ones I've been seeing lately. I've been chatting with a couple of companies that are Series A, and yeah, man, like for example, they outsource their marketing, so they don't really understand what was actually working with marketing. So kind of building or bringing that knowledge in house is expensive. They sometimes have to start from scratch. I've seen that a couple cases. another, I didn't write it, but another flag that I see with Series A companies is that they don't have a good understanding of their budget. At this point, we are dealing with burn rates, or not burn rates, but operation costs in the $300,000 a month. You want to understand where $300,000 a month are going. Like inside our biggest monthly operations cost was set up. We were building a few products and so on. We probably spend like $240,000 a month, $240,000 a month in operations costs. We were covering most of that with revenue, but when you're dealing with that kind of money every month, you need a decent spreadsheet that that makes sure that you're not overspending and that money's going to last where it's going to last. And I've lost count on the amount of companies that are trying to raise a Series A and they're only starting to get that stuff put together. We help a little bit with that, and that's why I know. But please don't be that company. Okay, so I have a lot of room for questions now because we're just 20 minutes. Great. So feel free to throw them in either chat, Zoom, or YouTube. But first, a couple of quick, very, very quick commercials, I promise. We started a new YouTube channel. I don't know if you guys knew this. The main Slidebean channel, like we cover all sorts of tech impact in society sort of topics, and we've grown a lot broader. I consider myself a YouTuber in that channel, but we have a channel that's mostly dedicated to what we've just talked about today. It's called the Startup Club. Started it about a year ago. We publish one or two videos a month, like on deep dives about all this startup stuff. We have this really good video on convertible notes that went out last week, and we have a new video coming up on how much equity founders retain after all of these funding rounds. That one's coming in a couple of weeks. So you want to check it out, subscribe. Deep dives on exclusively startup stuff. And again, like I said, like our core business is not making YouTube videos. We have a software platform that helps founders navigate through all of this stuff. It has an AI pitch deck builder. We have an investor finder with 20,000-30,000 investors that we've scraped for you, so you don't have to go do that yourself. We have a cap table tool that you can use to manage that. We have a financial model template, and we even have monthly one-on-ones. And I'll only stop for that in a sec on the monthly one-on-ones. So like with one of our Slidebean subscriptions, you get access to a monthly call with our pitch deck team and a monthly call with our financials team. And I also do a kickoff call with every company that joins. So it's literally us kind of like lending some time from experts and people that have gone through this stuff before, to help you improve your pitch deck or navigate through your financials, etc. So it's our main business. It's not YouTube, even though YouTube is the fun one, I would say. Okay. Now it's time for questions. So I'll stop screen sharing, and I'll take in your questions. Let's maybe do one-on-one. For you guys on Zoom, you can do the Q&A thing. Maybe that's a bit more structured. So Alan, hey Alan, what's up? Alan's one of our customers. Do you think AI could potentially change the game over time, i.e. with 1 million investment could potentially yield an EBITDA payback period of a half or a third someday? Maybe, but I think that a lot of like the most underestimated expense that I think companies have that makes things much more expensive than they think is just growth. Growth is really expensive. You have to experiment, you have to pay for ads. Even with AI now, like kind of flipping your question. AI has made our productivity experiences a lot better. We don't have to go to Google anymore, right? Like we can just ask GPT or whatever search ChatGPT. AI chatbot of your preference. So Google is struggling a little bit with ads and where to find customers. So I think that finding customers is not getting easier for companies. YouTube is now such a popular place to, a bunch of companies are establishing YouTube channels because it's still a very human way in which you can reach out to your audience. So I don't see that changing immediately, at least. Software companies can operate at a much bigger profit margin, but the venture capital game is very much still exits, not profits. All right, I'll take one from YouTube here. I'm from Malaysia. How can I use term sheet safe, or should I make my own term sheet? Lawyer must be incorporated first to get funding. Yes, you have to be incorporated to get funding. Absolutely. A safe, by the way, we have a video about that. Literally the video that came out last week. I'll ask my team to share it. Our video on convertible notes. But like a safe is a pretty standard document. It's a Y Combinator template. It's free. It's like Creative Commons or something. So you can absolutely use that to fund your next round. So yes, by all means. Okay. Scotty, has the hipster hacker hustler founder team trope been broken? Is the single founder still still a bad thing given the efficiency investors are looking for? Yeah, so this hipster hacker hustler idea was that the ideal founder team was three people. One hustler, that's usually kind of like the CEO persona, that can sell, that can market, that can sell not only to customers but to investors, right? That's the idea of a hustler. You have a hacker, that's usually the technical co-founder, somebody who can obviously build a platform, maintain it, etc., like build a product team around them. And the hipster, that's usually this role of design, UX, or marketing, right? Normally hipsters or marketing roles tend to be hipsters. And as you have that combination, I still believe, kind of echoing Y Combinator's rule, that two of those three founders should have technical skills. Maybe not full stack developers, but technical skills. So I don't think that structure has been broken. Not at all. On the single founder question, again, I was reading this report, we're making a video about it, but it's like 35% of companies are started with solo founders. And yet only about 10% of funded companies are solo founders, right? So there's a big misproportion in how many companies are started with a solo founder and how many companies actually raise money by having a solo founder. And there are a bunch of, I don't want to say red flags, but flags with solo founders. Again, not having a network to recruit a team, struggling to find their first hires, etc. It's a bit of a flag, not a deal breaker, but a bit of a flag. I think it still is. Hi to David, who sends regards. Average team size at every round. Oh man, I don't think there's a good rule for that. I don't think there is one. If there is one, I don't know what it is. I'm sure there's a study on it, but I don't think there's a hard rule on it. I'll do another one from YouTube. Alfred, we are an engineering-focused IT SaaS, pre-revenue, have experienced product development executives in place, need dollars for sales execs to scale, seed or pre-seed? Pre-revenue. Sales, experienced product development execs in place, dollar for sales execs. I'd say you're pre-seed. Again, if you don't have revenue, you're not a seed company. I'd say that's generally the rule. I mean, pre-seed is quote unquote bad. I mean, not bad, but it probably means a smaller amount of money. Like pre-seed rounds don't usually go above $1 million. They're more in the 500K or smaller range, right? So like the amount of money that you can raise does correlate to the name of your round. But I would much rather, be overqualified for the round I'm trying to raise than be underqualified, because you might waste a lot of time with investors that will just say no because you're not at the place where they expected you to be. Okay, Alvin, what should a public benefit corporation looking to raise keep in mind? Public benefit, I'm assuming nonprofit. I'm assuming it's the same. I don't know, but I want to say, the rules are very different. Not my experience. I don't want to spitball. I'm sorry. Not I'm not that familiar with the structure of a nonprofit funding round. I'm sorry. I'll take another one. Sorry. Richard, do you agree with this opinion? Any investor who is not interested in a convertible note loan in a startup is trying to rip you off. No, I wouldn't agree. I wouldn't agree with the statement. Some investors just don't like convertible notes, and I can see why. I made a video about this last week, literally called "Beware of Convertible Notes." So, I mean, again, we'll link it. We'll link it if we haven't. Yeah. So I think that some investors just don't like convertible notes or safes. They have some predicaments. They have some catches. They're overall a good, well-structured deal, but I wouldn't say that an investor that disagrees with a convertible note is a bad investor. I don't think that that's the rule, especially inexperienced investors, friends and family, or investors that are investing for the first time. A convertible note is a bit of a complicated structure for a round, much more complicated than equity, which is complicated, but not that much. So yeah, not a deal breaker. I'll see you at the Yori. What's typically required to initiate a pre-seed round? Bootstrapping, developing our MVP, stakeholders requesting projected financials, but we haven't raised external funding yet. Yeah, but this is a common question we get on the financials, right? So you're raising a pre-seed round. All of your when people write pre-seed round pitch decks, they're always thinking, oh, like let's do let's talk about this product. Let's brag with these beautiful mock-ups. But there's no forecast of how much you're going to spend in growth and where that growth is going to get you to, which is by all means a financial model, like at least a little spreadsheet. We have a template about it, remember, on Slidebean. It's free. So the this idea that you do need financial forecasts at pre-seed, I think is very valid because remember that the pre-seed round needs to get you to the seed round. And the seed round is a round that you get with revenue, with expenses, with marketing dollars. So very much a homework that you need to cover, even if you're a pre-seed company. All right, I'll take, do you think YC is going to accept us in this AI age? Well, I don't know what your company does, but YC still exists, still takes a few hundred companies a year. So I guess it depends on what you're building. I'd say that it's unlikely that Y Combinator will take like a traditional SaaS company. I don't think that they're doing that anymore. Or the company needs to have a lot of traction for that to be a possibility. Their Y Combinator has moved into kind of like higher like R&D type startups, or like much more disruptive things than just software startups. Not to say software startups. Most companies are still software startups, and there's still a lot of room in SaaS to grow. So yeah. I'm building an AI security software for retail in Nigeria. Do you think I can start searching for investors before launching or pitching my prototype to customers? Again, sounds like you're a pre-seed company. So if you fill in the pre-seed requirements, by all means, go for it. Nino, anytime I could chat, I could grab a link to the Zoom meeting so I could send my question. I get limited by YouTube's character limit. Don't send such a long question. I don't want to read it. But just throw it in here, man. Don't worry. I'm going to take one from Zoom now. How much money do you raise for Series A and how much revenue, and same for Series B? Those varies. Series A rounds, I want to say tend to be in the 5 to 10 million, I want to say. And today, it used to be very different. Back when we were trying to raise a Series A, which was back in 2016, 17. Series A were smaller. I think we're going for like a $3 million raise. But post-COVID, it's a little different. Like rounds did get a lot bigger, not just because of COVID. Just rounds have gotten a lot bigger lately, especially because there's pre-seed rounds in them already, right? So if your pre-seed round is $500,000, your seed must be 1-2, then your A has to be probably 4 or 5, right? Like that's just on that scale. Hijabi, you have nuanced, and I love the nuanced answers. Okay, cool. Kuro, so saw you raise the seed round and then pivoted at the end of runway. Would the next round be back to pre-seed or seed? Man, I'll be super honest with all of you, and that's why we do these things. We today, Slidebean is not a venture backable company. That's just what it is, right? We haven't grown too fast in the last few months because we haven't had investor cash to burn to grow quickly. So that's not our case. We're around. We've been around for 10 years. That's also too long for a startup company. So I don't. Yeah, like I operate a little bit in the middle. Like I live that life, and it's very much. And when I say I live that life, it's very much a life. Like it's this fake it till you make it life stuff. Like you see in these starter posters. I think it's true. Like when you're operating a company that needs external capital to survive, and you need that external capital injection every 1 or 2 years, you're always racing. There's this thing that they used to do at 500 startups. We did 500 startups, which is like Y Combinator. It's called ABC, always be closing. Like you're always raising money. You're always in this mode. You're always pitching your company. You're always talking to somebody who might be your investor. And there's always a round of funding that's going to happen within the next year and a half, right? So every connection that you make is a potentially valuable future investor. So you're always in that mode of selling. And that's why, startup founders, I think fairly get stereotyped as like always like bullshitters. And it's kind of true. We've been around for long enough to not have to bullshit anymore. Like we're very honest about where we are as a company. It's not that hard to figure out. We've published many of our financials publicly. Our financial, I think we actually made this. We published our actual financial model the spreadsheet that we used from 2013 through 2018, I think, with everything except salaries is in there. All our revenue, all our number of customers, and all that. Like all that, it's in our blog. You can look it up. Um, just as a, it's a way of saying like, hey, like we're no longer playing this game, at least, or I'm no longer playing that game with Slidebean. I might start another company in the future, and I might need to go back and play that game again, but not today. Okay. How do you evaluate the percentage of equity to give away in a press round for the amount of money they're giving? That's a really good question, Steve. I didn't talk about valuations. Maybe I'll add those slides for next time. By the way, I forgot to say we're doing a webinar, another session tomorrow on the start. This one's going to be on the Startup Club channel. It's a little bit more technical on actual startup forecasting. I forgot to tell my team to paste the link, but they'll do it. So it's a bit more advanced technical, same time tomorrow, but on the Startup Club channel if you want to check it out. Okay. Sorry, back to your question. Yeah, valuations tend to operate a bit about standards, right? I said that $1 million, 15%. Like most funding rounds, believe it or not, tend to be in the 20, I want to say 15 to 20%, sometimes 25% range of equity. And that is completely nonsensical if you think about it, because like, hey, why are we saying that this company is worth $4 million if they're just three guys with an idea? Well, yes, because of the potential, right? And then we get asked sometimes, hey, like I want to do like a discounted cash flow forecast of valuation for this business. So, well, do you have revenue? So, no, we're just forecasting what the business is going to make in revenue. It's like, well, every company that's raising venture capital is on a path to being a unicorn, right? And every company is on a path to hundreds of millions of dollars in revenue. So that having those forecasts doesn't make you different. So rather than, at least in pre-seed and seed, valuations don't correlate to revenue, obviously, because it's too small. They don't correlate to potential in the sense that if your company has a small potential, you're probably not a venture backable company. If your company has this huge potential, then yes, but then you're just like everybody else. It's super counterintuitive, honestly, it is. But that's just how it usually operates. There's a bit of FOMO too. I've talked about I know a couple of founders that were able to essentially double their valuations because they managed to get investors to compete with each other, right? So FOMO again. You have two investors that are very excited about this company. One gives you a term sheet for X amount of millions of valuation, and the other one says, no, like I want to invest instead. I want to up that guy, like one up that guy. So okay, great. So here's a new valuation. Here's a better valuation, which is great for you. You retain more equity. You obviously put a bit of a new requirement for your next round because you need to realize that valuation somehow. But yeah, valuations respond much more to those dynamics, to how desperate the company is to raise money or how many connections the founders have, rather than numbers or metrics or spreadsheets, at least at pre-seed and seed. At Series A, you normally have revenue and you have a good visibility on where the company is going to go. So that's where mathematics play a much bigger role in estimating what a valuation is. Good question. Okay, I'll say let's do one from YouTube. Founder mode. Yeah, that's what I was talking about. Is there a possibility of raising funding for social media startups, and what are the thresholds for today's VCs look for? Yeah, I mean, you can raise money for social media. That's not technically an R&D startup, right? It's more like a software company. But even though you're not making revenue, you essentially convert those 20K or 2 million ARR, convert that to what the equivalent in customers might be. You might look at other companies. I mean, Clubhouse, I think, is a bad example because Clubhouse raised a lot of money because there was a lot of money in the market when Clubhouse rose during the pandemic. So I don't think it's a great example. TikTok isn't also because Chinese company, but what's the last social media company that raised, kind of like established rounds of funding? I don't know if it was Snapchat, Be Real maybe. And then like look at those rounds and kind of correlate how many customers they had or how many users, monthly active users. By all means, monthly active users, right? Not signups. Nobody cares about signups. How many they had at each one of those funding rounds, and you can kind of set those milestones yourself, even if you don't have revenue. Fair question. I'll take one from here. Delaware Benefit Corporation. Sorry, man. Like Alvin. Delaware Benefit Corporation is a for-profit company that must pursue a public good and consider all stakeholders and protects its leaders from lawsuits for putting purpose before benefits. Sorry, I was not familiar with this legal structure. Why would you want to? I mean, if you're a for-profit, do you think that this company structure will make it easier to raise money because it usually doesn't. I mean, investors are kind of like they like Delaware C corps, and those are pretty much standardized. Elon has kind of moved some people away from Delaware. Wyoming C corps are becoming popular too. But you essentially want to go with a standard, unless you're looking for a different kind of investor. But if you're looking for VCs, Delaware C corps, that's what they invest in, and it's almost a requirement, I'd say. Definitely not LLCs. Definitely not LLCs, Joey. I see your question. Okay. Is it hurtful if you raise $1 billion in one time? I mean, if you can raise $1 billion, then hire me. But I think it was in the news, like the first $1 billion round. It was one of the OpenAI's former CTO, whose name I'm forgetting. I'm sorry, but yeah, they raised a 1 billion seed. It's the first time it's happened ever. So okay, we are building a car rental marketplace for Africa. Do you think we are going to get accepted in YC at this AI age? Well, I don't know. Car rental marketplace for Africa? That's like a Turo? I don't know. Um, I don't have enough information to say. But I mean, Y Combinator obviously is the one that makes the call. But yeah, I mean, I'd say traction is like traction. I mean, this is a good. I want to stop for a second and talk about it. Like it sucks a little bit because it takes money to make money is this thing that you hear, right? And it kind of does. Like if it's really important that it makes a big difference in your chances of success if the founders have a little bit of money to spend to bootstrap the company early on, or if the companies have been able to save money so that they can bootstrap for a few years before they go to investors. It helps a lot if your family has money, obviously, so you have essentially a free, not a free, but a friends and family around that you didn't have to fight for like everybody else. Um, or if you've had a really good job for a long time, you've been able to save money, and then that makes starting a company easier. And that's just the truth of it. It's just what it is. Um, but the reality is that since building a startup has become a much more popular way to make a living, the requirements have gone up, right? Like you used to see, the Reddit story. We made a video about this on Reddit on how they got accepted into Y Combinator. They didn't even have the idea. Like they got accepted just two really really exciting people, and they decided that they were going to build Reddit in the first 2-3 weeks of the program. That's a true story. That doesn't happen anymore, right? The place where we are now is that there are a lot of people starting companies. There are a lot of resources available. Hopefully, we've contributed a little bit to that. And most companies, by the time they apply to YC or other accelerators, they have stuff going on for them, whether they fund it themselves or they raise money elsewhere. But so traction, I think, is a big question I'm sorry, part of the answer to your question. What else do I have? What else do I have? Well, I'm closing this at the 12:30. Yeah, 12:30 Eastern. So, last questions in last 10 minutes. Okay. Must the startup be incorporated in the US to raise funds? Absolutely, yes. Kanave from South Africa. Is it possible to raise money with zero traction? Yeah, we talked a little bit about that. Maybe rewind. You're a pre-seed company, sounds like. So yeah, just go by the pre-seed rules. What do you think could be tech-related growth opportunities for a distribution company? We implemented an ERP which 4x'd our growth, but we plateaued at 2 million ARR. I guess the question is, I mean, zoomed out question for everyone is like, are you a venture backable company? Right? Remember what we established. It's a company that's headed to an exit. That exit must be in the hundreds of millions of dollars. That means that your revenue must be in the tens of millions, potentially in the hundreds of millions of dollars of revenue. Like that's a requirement for any venture backable company. If that's not what you are, then you shouldn't be after venture capital investors. There are other, I mean, if you have $2 million in annual run rate, you've been operating for a while, you can raise money on loans, right? That's the way traditional businesses raise money. So VC money is very risky, but it comes with those strings attached. The expectation of very fast growth. Yashpreet, I'm working on our pitch deck. I wanted to show calculations for some serviceable, obtainable market. I think it paints a clear picture of our current target. What do you suggest, keeping or changing that to TAM? We made a whole video about this. I don't know if you've watched it, Yashpreet. Our video on TAM from I think 2-3 weeks ago on the Startup Club channel. Good thorough video with Steve, who's one of our investors, as a guest. Okay, Kuro, in a geographical market agnostic startup, how much of an advantage is it to relocate to San Francisco nowadays? Ah, that's a great question, man. Such a great question. Uh, do you need to relocate to like a really expensive city? I want to say it's definitely less of a requirement than it used to be. Um, Absolutely less of a requirement than it used to be. Like it when I raise money for I'm Costa Rican, in case you didn't know that. I'm Costa Rican. Uh and so I was very much an outsider to startups. And the first company I would try to fund, I was living in New York back in we got accepted to this accelerator, so I lived in New York for like 3 months. And we tried to raise money with this idea that one of us would remain in New York and the other co-founder would go back to Costa Rica and establish a team there, like establish like our dev team back in Costa Rica. And that was a deal breaker. Like raised eyebrows, nobody liked this idea. I think that's very different now because tech talent has gotten very expensive, very scarce in the States. Less now that have been so many layoffs post COVID, et cetera. But yeah, like there is a good understanding that you don't have to be in the same room anymore. Um, and you don't have to be in an expensive city anymore. Now, that being said, I do firmly believe that you need to be within the capacity to get your team together easily, right? If your team is operating on different time zones, I mean, like extremely different time zones, that makes things a lot harder and makes things a lot slower. I think chances of success are smaller. Jason Calcana has asked this question the other day. Like, do you think the iPhone would have been Apple? Do you think that Apple would have been able to build the iPhone on a fully remote team? The obvious answer is no, right? There is some intangible physical collaboration of a team, and the next company I start, I will very much expect to be at least in the same city as my co-founders. Now, for fundraising, like I do think that the CEO persona and eventually the sales and the marketing teams, they do need to be close, not only physically but culturally to a major city, marketing and sales. Like, and you see that the biggest companies, the ClickUps of the world that are spending millions of dollars in marketing. I mean, they operate remote. A lot of this stuff is remotely, especially the tech side, because an engineer's job is very much, hey, like let's do a briefing once or twice a week, and then I'll just sit down and code, right? Whereas a marketing person or a salesperson's job is requires some work connections, especially managers. Yeah, so I don't think it's a requirement, but I think it adds value. I wouldn't do like if you're bootstrapping, and you don't have to live in San Francisco, don't live in San Francisco or New York, right? By any means. Okay, but yeah, like taking Austin as an example, Austin is not as expensive of a city, but there is something about being in Austin, right? You have all these meetups happening, you have a network, you build a network, you meet people that you might eventually hire or that might eventually fund you, right? If you're lost, I mean, I'll use my own example. If you're in San Jose, Costa Rica, there's very little of that happening. So that puts you at a disadvantage. And I think investors do add that to their decision making. Okay. Does the bottom up approach still work for market size, like in the pitch deck? Yeah, for sure. Do bottom up, never top down. Um, What's the next big thing for Slidebean? That's a good question. Remember, you had a trailer for a platform where you could have like assistant for your company. Yeah, yeah, yeah. We built a couple of products that didn't work out. Like that's kind of like where we are, and I guess maybe a good thing to talk about for the next 2 minutes. Yeah, like we that's yeah. Taking a step back, like there's in startups, right? Winning is selling your company, and that's just the truth of it. For investors, if you're a venture-backed company, winning is selling your company or IPOing. But that's not to say you can't build a company that doesn't do that, and it's still a successful company. Like I think Slidebean is a successful company, even though we've had to scale down the team after we run out of cash. We have a YouTube channel, we have the software side, we still make money and operate profitably, and I enjoy what I do. So but in venture capital terms, that is a failure of a company. Luckily for us, we didn't raise enough money so that our investors would be mad at us for like and pushing us really, really hard to say like, I need my money back because they didn't put in that much money. We didn't raise that much money, luckily. So whatever Slidebean is now, even though it's not scaling at startup speeds, is bigger than the valuation that at which they invested in. So they're chill about it, even though it's taking us 10, 12 years since we started Slidebean. So that's not to say it's a failure by general standard, but it is absolutely a failure by VC standards, and we're all very much aware of that. So we tried building a few products, a few side products, and that's why maybe what you remember, we built a couple of like set aside some money out of our own profits and just build a couple of products with the idea of, well, if this product picks up, we might raise money to grow that product, right? Kind of like a strong pivot. None of those worked out. One was essentially Chat GPT assistance before Chat GPT actually launched assistance. So it's like, well, now why do people need this anymore? And we had built like a SaaS tracking platform too that and I think that's a good lesson too. Like I think the idea was really good. A lot of companies, we kind of started building it, and in the span of 6 months, when we were building slow because we were building on our own revenue and profits and still running the other product, like 3, 4, 5 venture-backed companies came in trying to do the same thing, and then we were outrun, right? And that's also a part of this whole venture capital game, which is you have to raise money and you have to spend aggressively because there's a good chance somebody's building what you're building, and the winner is the one that grows faster, and not always the better product, to be honest, just the company that grows faster. So yeah. Anyway, can you give general advice on how to get loans? Ask for discussion. It seems to be very difficult for us to get VC money. Yeah, so loans work. I mean, I would never, ever, ever, ever take a loan where I am personally liable for a company loan. Like I would never do that. I did it once with my credit card, essentially, with my first company, and ended up with a bunch of debt that nobody else paid for except for me. So that sucked. So I would not be personally liable for any money that the company takes. But yeah, if you have revenue, right? If you're a more traditional business, you have revenue, you started slow, it's you can go to banks and raise money. QuickBooks and Stripe, they all have like funding alternatives too. Did Slidebean join YC? We're not a YC company. I got to interview. I did a YC interview, but we didn't get in. We got into 500 startups instead, like a couple months later. 4 minutes left. I'll take yours, Corinne, maybe the last one. Say you have a growing company in your Costa Rica and you're in 700K ARR. However, your product would work in the US, but it's easier to get funding. How do you decide if it's worth abandoning what's been built? I mean, I wouldn't abandon something that makes money. I'd try to find a way to sell it, right? You have all these platforms, all these marketplaces that buy and sell companies, and it's not 5x crazy multipliers, but you can sell it. Somebody else runs it, operates it, transfer the code, and you get cash in advance. So I wouldn't abandon something that's working. No. I would, if I were to start another company, I would probably do that in close to a major hub. Like living in New York is very expensive, but I would be in a major hub. I think that being far physically and culturally from a major hub is a disadvantage. And I don't know what my life is going to be, and then by the time I start the next company, but I would probably try to be in a major hub for sure. What kind of validation do you need to pre-seed? Yes, letters of intent, good. A lot of customer conversations, good. More about, the pre-seed decision is more about your founders believing that you guys can build this. Much more than validation. I mean, it works, but yeah. Who decides valuation? Usually a negotiation between you and an investor. You can propose, and they can propose back. So normally that's what it does. Okay. I think I've covered all those. Right. So thanks. Last closing notes, please don't leave. Thanks a lot for watching, guys. Like, really, I see 120 people on the live stream. That's crazy. We haven't done live streams on our main YouTube channel in a while. Do you want us to do more? Like, let us know in the chat or comments. We can find new stuff to talk about. Slidebean is free. We have a bunch of stuff that's free. There are some subscription plans, but there's a lot of resources that are free, including the financial model. So if you found any of the stuff I said useful, it's all been well documented either in our Startup Club channel or in our actual platform. Just sign up free at slidebean.com.